All right, so hello and welcome to our webinar, the 2024 Mid-Year Economic and Investment Outlook with Terry Alexander. My name is Eric Danielson. I'm the Communication and Client Services Administrator for AFP. We are recording this webinar and we'll be recording future webinars as well. We will hold a Q&A session afterwards and we will stop the recording before the Q&A. The video for this webinar will be posted on our website within the next few days. So in order to make sure this runs smoothly, we've muted your mics and disabled your videos. If you have any questions during the presentation, you can post them in the chat. Um, excuse me. And then once we're finished, we'll re-enable the option to unmute yourselves and ask questions. So if you do have any suggestions for future webinars, we encourage you to post them in the chat or shoot us an email or give us a call later on. So with that being said, I'll hand things off to Terry.
Thank you, Eric. Well, we really appreciate you coming and visiting us today on our mid-year outlook. It seems as if so far it has been anything but dull, especially for July. So to kind of start out, I think, we have that one, and we'll just skip through some of those. It's been 2 months since we've done one of these. The one thing I think is important is that it's good to kind of go back and just simply reflect on what has happened for the first half of this year briefly before we kind of move forward. And they often say that good years follow great years. And so far, when we look at year-to-date numbers for the different sectors of our market or areas of our market, you can see in that second column that things have gone pretty well so far this year. We have a few areas, real estate specifically, some of the fixed income areas, specifically intermediate to long-term bonds, are still in negative territory. But when we then dial into the second quarter, you do start seeing a few more red numbers appearing, mostly in the mid and small cap area of the US market for the second quarter. Real estate, again, it was experiencing negative returns, and some of the international markets as well, along with long-term fixed income. But I think it's important to see this because when we look back in the first half of the year, there really have been three themes that have dominated, and they've dominated more going back to November of last year when the market took off in 2023. One is that giant companies have substantially outperformed even large companies. So those are made up in the S&P 500. And clearly you can see that in the rate of return on a year-to-date basis. The second is that growth has outperformed value. And again, the S&P 500 index used to be considered a more mid-large area, and it's moved clearly into the growth area due to the fact that we've got a lot of the technology and artificial intelligence companies in that particular area. And then the third thing we have seen continuing through the second quarter was momentum. Anything that was large growth and had a momentum drive behind it, specifically AI, was dominating clearly the returns, the positive returns in the markets at that point in time. But, you turn the page, we're moving into the third quarter. July has been anything but dull. So it's a good thing I haven't taken a vacation. But I can say that the second half, we're starting to see emerge a very different picture than what we've been seeing up to this point. And so for that, what we have started seeing is value actually outperforming growth and small company performance outperforming large companies. And for the last 12 days, actually the Russell 2000, which is as you see here on the third listing under asset index categories, it has actually outperformed the S&P 500 by over 12.7%. So that has created a new record in the extremeness between those two markets. So when we're moving into the third quarter here, there's some things to keep in mind. We've got a very actually a very nice market or economy, I should say, as a backdrop at this particular point. The economy is remaining solid. We are seeing some slowing in particular areas. One way that we measure what is happening in the economy is by the gross domestic product, GDP. And for the first quarter, it was fairly low, 1.4%. We just got the new numbers for GDP yesterday, and they are coming in at double what the first quarter was, 2.8%. Now, I will say that reading usually gets an adjustment, two more adjustments before they say this is a firm number. So this is a first number out the gate, so to speak, but it will get adjusted here a tad as we move forward. It could move up, it could move down, but bottom line, that this is our initial take on what happened in the second quarter, which is much higher than what was expected. It was expected to come in closer to 2.1%. So let's just say that was a surprise. The second is kind of looking at, we're not hearing it much, but really what we've been experiencing potentially has been kind of a rolling recession. And we hear the term soft landing or traditional recession. We have not had this. It was like the thing that everybody was looking for, just wasn't happening. And now it's kind of gone out of the media information altogether. But at some point, we will be experiencing some element of a recession. And the consensus is we might be experiencing more of a soft landing than anything else. But a recession really just isn't on the horizon right now. At least that is what we are hearing from the economists out there at this particular point. The consumer, which makes up roughly 70% of GDP, has been resilient. So, we are starting to see a little bit of stress in the lower income area. Debt is rising in that particular area, but higher income consumers are feeling pretty good right now. Their values they see in their investments and the like have been trending up. Values in real estate, have been doing well. So we've got kind of a bifurcation as far as the consumers out there and how they are really experiencing what is going on right now. We have a strong labor market right now, and there's been a surge in immigration, which really has not been bad because being a more heavily service-oriented economy, they're the ones that are doing the jobs that many people don't want to do. Such as taking care of hospitality and hotels and the like, and just doing a lot of jobs that a lot of even kids coming out of high school no longer really want to do. So that has actually helped improve the growth of the economy. Wage growth is actually around 4%, and historically it's been 3.9, so it's higher than the average, which is good. On the flip side, we look at unemployment rates, and they came in just recently at 4.1. This has ticked up from 4.0 in May. So we have actually seen several months of unemployment ticking up over the last, I think, about 18 months. And this is a little bit of a concern if this trend continues, and it has been just slowly moving up. The historic average has been 6.2%. So, but when we start seeing this general trend moving up, that used to be an indicator, and again, some of these indicators have gotten broken, that if we see it trending up to 4.2, that could be a sign of moving into recession, but they're not really thinking that that is going to happen right now. So again, we're just looking at these numbers and looking at the trends that we are seeing. Inflation and interest rates. Inflation for June came in at 3%. So that is trending down. Previous month was 3.1. Prior to that, I think it was 3.3. So it's been somewhat stubborn and sticky as far as inflation goes, but we are seeing a trending here in a downward trajectory. And we're also seeing high short-term interest rates, and we're still experiencing an inverted yield curve, which we're going to look at here in just a minute. Large cap stocks, valuations, elevations continue, let's say through mid-July. We have definitely been experiencing a pullback in the large cap specific artificial intelligence, technology, consumer services area within the last few weeks. So that's new for the month of July and being the first month of the third quarter. We are going to experience some uncertainty with the presidential election and the geopolitical risks. So these things are all the underlying currents. And we will look here a little bit at presidential elections and how they impact the market as well. So three engines drive the economy. And this is my simplification of maybe helping to understand the economy and the growth in the economy. We have to have one of these engines firing at all times in order to keep things moving forward. During the pandemic, the consumer and the business engines were clearly turned off, and it was the government, i.e. stimulus, that was kind of keeping things moving along. The government may have given us a little bit too much stimulus because it then created, coming out of the pandemic, pent up demand along with the supply chains being broken, really created a true bottleneck around that time frame. And so that is really what, for one reason, one of the larger reasons was why inflation started taking off, because we had a greater demand than we had supply. And so unwinding the inflation predicament has been what we've been experiencing. But we are getting back to some normalcy, which is kind of nice to see. Now, and all the indicators are giving us good reads right now for what they historically have been showing, but the recognition is there. And so we are looking at that. The consumer right now is on fire. They have been spending, and the area that we are seeing a little bit of slowness coming in is in the services spending area, which does make up a majority of the consumer spending. So that is real short term that we've been seeing a little bit of a pullback in that area. The other one is looking at the differences between higher income earning people versus lower income earning people. And in that lower earning income area, the increase in debt is starting to be felt a little bit, in addition to people just feeling generally squeezed in a lot of different areas. So the consumer engine is on, it's doing well. We are seeing few little areas here throttling back a little bit in this. But when we look at the business engine, that's the one that is actually coming on and doing very well. And we've seen a real pickup in business spending and equipment, software purchases, and inventory. So they are ramping up in those areas and seeming to do pretty well. The government engine, there's always a little bit on there, but it's kind of been pulled off of here. So that's my analogy of kind of looking at what's happening in the economy at this point in time. And that's backed up by looking at numbers. So this is GDP. Again, I updated this last night, which would have been the day before. So this chart is really just giving us a read up to first quarter. We didn't have second quarter numbers in yet at 2.8%. And as you can see, what makes up GDP, consumer, a little bit of government spending, investment, spending, housing, and the like. So we're seeing a general upward trajectory right now in GDP or in gross domestic product. Another thing I like to look at is inflation. What is making up inflation right now? And I also think this chart's kind of cool looking. It's a new one that JP Morgan has put into their index stack. So I pulled this in because you can kind of see where the numbers for inflation come in. And if we come down and look at the very far right, June 2024, you can see maybe 3.0% for the month of June. And a majority of that is actually being made up with shelter. So it's very sticky on the housing side. Those costs are very high right now. And that's really the part that is keeping inflation elevated at this particular point in time. You could also see core goods is actually negative territory. So those prices have actually fallen. And so that's a real positive sign on here. And energy costs are very minimal at this particular point in time. So we are seeing that trend, but you can see that the trend is leveled off. It's slowly moving down. Federal Reserve would like to see us at around 2%. That's been their objective, and that objective might actually be changing by the end of this year because many economists out there feel as if 2% is actually too low, and maybe closer around 3% where we are is a more healthy level for inflation. But we will see. They're still working towards a 2% as far as I know. So moving on and looking at inflation, and this is kind of getting into a discussion about inflation relative to interest rates. So if you go back and look at the very front left side of this chart, and you can see 1974 through 1982. This chart is showing what, on the blue line, what inflation did at that point. It was going up in 74 due to oil embargo, energy related expenses. And as inflation was increasing, the Federal Reserve back then started raising interest rates to combat inflation. And they did. And so as they did that and inflation started coming down, then they started lowering interest rates. And unfortunately, they lowered them too quickly and inflation came roaring back. And so they had to move interest rates up rather swiftly, similar to what we just recently went through. And they had to make sure that inflation's the monster was the head was actually dead. And so then they started lowering interest rates. But again, they took a little longer to do that because of the whipsaw impact that happened with the first movement in inflation and then interest rates. So that is one thing that the Federal Reserve, if anything, we try to look at history to learn some lessons. And that's one reason why the Federal Reserve chose not to start lowering interest rates this time too soon. They wanted to make sure that when they start lowering them, the economy is showing that it is slowing, that we are seeing certain signs within the job market, and that inflation, is actually coming down. So that is one reason why we haven't seen interest rates being reduced at this particular point. Right now, I think 90% of the economists out there, maybe it's higher than that now, are projecting September to be the first month that we see interest rates coming down. So I just think this is a great visual to better explain why maybe we've had a little bit of a lag in time for this change. We have experienced 11 rate increases, and they were very fast and furious rate increases once they started to do this. And actually tomorrow will be the day that it was the last rate increase last year. So we've been sitting here with no rate changes for now 1 full year. And so the Federal Reserve did raise interest rates very, very swiftly. Typically, they might not have done that in the past, but and to combat inflation, and they maybe were a little bit behind the 8 ball to do it, the rates were increased rather swiftly to get to that particular point. And we've been sitting here for a year with no change. Now we are looking at the possibility that they will be starting to reduce interest rates because they feel inflation is coming down and the economy is slowing a little bit for the readings that they are looking at. And so it is projected that we will get a 0.25% rate reduction starting in September. So, and it's best actually, and they've done studies, that if they lower interest rates slowly, it has a more favorable impact on the markets. Whereas if they try and lower interest rates swiftly, it can have a more negative impact on the market. So I'm hoping that they're going to do it slower than quicker. That would be my thought. So where are we today? Right now, we are looking at the consumer being the main driver of the economy as far as growth goes. And it's been resilient. It truly has been. Inflation is trending down, so we are seeing that. The high was 9.1 back in June of 2022. And again, we've got this Federal Reserve objective of 2%. We'll see. As far as interest rates cuts, September is kind of the projection. Whether we're going to get another one potentially in December, that's maybe looking out a bit too far. But that is a thought for some economists, and others are thinking, no, we're only going to get one. The one thing I can say here is that Europe and Canada, several other developed and emerging market countries actually started reducing their interest rates in June of this year. So that was kind of an interesting one because that's typically only happened two other times in history. Usually the United States is ahead of all the other developed countries in making this cut. And because we had such significant growth in our economy and in the markets, we weren't the first ones here. Whereas in Europe and United Kingdom and the like, they weren't experiencing that same level of growth. So they were able to, in essence, say, let's start cutting rates earlier than we did. But there will be a positive ripple effect when this happens, and just kind of, and generally this is going to be very positive for the housing market, which has been the sticky part of the inflation side. So this is going to be a good thing once it really starts happening. It's highly anticipated. So that's kind of where we're at right now with that. As we move into this third year of a bull market, which will happen after October 22nd, that we start seeing some changes occurring here. And the market, we've got to remember, is a leading indicator. So we really did not know that we had hit the bottom, and that being October 22nd, until maybe 6 months or 9 months after the fact. So you kind of have to look at this backwards to understand where we're going forwards. But the market will typically be a leading indicator of the economy. So it moved up before the economy started moving up, and it will move down before the economy moves down. Well, I don't think we're there yet, but it's just something to kind of keep in the back of your head. And we are also starting to see a broadening developing here. They call it the underdog rally right now because we are seeing small caps taking off, and this has not happened for several years. We're also seeing value participating versus growth, which again hasn't happened for quite some time. So these are all things that are starting to gel moving into the second half that we weren't seeing happen in the first half of the year. And obviously we have a presidential election coming up, and looking at the presidential cycle, I think, is important. So some studies have been done to say, how does the market do in a presidential year? And so if we're looking on the left side, you see presidential cycle year 4, and these are the averages that the S&P has has experienced in each of the quarters of the 4th year. As you can see, first quarter positive, second quarter positive. Yes, we had 2 positive quarters, maybe more in reverse order. First quarter did better than the second quarter. But the third quarter, fourth quarter have historically also been positive, giving us a positive year for an election year. And it has not mattered whether it's a Democrat or Republican getting in. This is just kind of the average of what we've been seeing. As far as the batting average going across to the far right, and looking at the percent probability that we can experience these returns, you can see in the far column for the year, 100% so far, going back to 1944, that the 4th year of a presidential year has been good. So the other thing that we have heard is that you typically, moving forward, have a positive market environment if you have one regime in the White House and another regime in part of the government. So you have more of a mixed bag versus it all being Republican or it all being Democrat. So that's another one to kind of keep in mind just as we move forward here. So positioning for the second half of 2024, how do we look at our portfolios? Do we make any changes here? What might this look like? And the one thing I kind of wanted to say, given the fact that we know things are broadening out at this particular point, is that many times I think, I'm going to click back to this one. Yeah. In the sense of our portfolio, in looking at how we are positioned right now, I think a lot of 401ks, 403bs, and the like have been very heavily tilted towards large growth, specifically the S&P 500. And so that might mean that we're a little bit too heavy, too concentrated in that area. And if so, the end of July will clearly show that because that area of the market has been coming down some. If we have a more broad exposure to the market, then we're not going to be as impacted with this. And that's the plus of July, is that we've started seeing this rotation and the broadening of the market coming into play here. Real estate also has not done great so far up to this time, but as interest rates start moving down, this might be an area that will do a little bit better too. So the one area that I want to look at is fixed income. And so fixed income kind of brings into play what we call the yield curve. The yield curve is really measuring the rate of return that we're receiving at different periods of maturity of anything we're holding that could be fixed income. So as far as money market funds are concerned, that's very short-term money, less than 1 year as far as internally what they're investing in. And in this chart, you can see the second line. It says July 24, 2024. That is our current yield curve, which is basically saying it's steepened since the beginning of the year, also this time last year a bit. And so we see very high on the short end, and then it kind of comes down, and then it's popping back up a little bit. If we go out 20 years, it's 4.6, and then it comes down again 30 years at 4.5. A normal yield curve would say that we're earning less on the short end and we're earning more on the long end, which might be closer to the line at the bottom of this chart, August 4, 2020. So that was about the last time that we kind of had a normal yield curve, although you kind of want to see it a little steeper than this on the longer end than what we're seeing here to be truly a normal yield curve. But suffice it to say, we've actually been in this inverted yield curve for the last 20 months, which is unheard of. It's usually an indicator that suggests when you go into an inverted yield curve that a recession is imminent, and we haven't had that this time. So this is one of those indicators that is broken and is not being able to be used as it has in the past. But on the short end, I know the Schwab money market fund, the taxable money market fund, is yielding about 5.113% right now on the 7-day average compound yield. And then as we go out, we're seeing, it moves up and it moves down. But, this is just an understanding that this is where we are right now. And to be real normal, we would like to see this yield curve be shorter on the or lower on the short end, and we're gaining a higher rate of return on the longer end of the curve. So what we have been doing is implementing what we call laddered bond portfolios. And this chart is just kind of giving a little background on that. But basically what we're doing here is we're trying to capture some of that yield on what we are experiencing now, because if interest rates are going to start coming down and that impacts the short end, it will also start impacting the long end. So if we can capture that and lock in a higher rate of return going out 3, 4, 5 years, which we have done in most of our portfolios now, then that's what we are doing. And we started doing this about a year and a half ago because rates had finally come back up. We haven't been in this situation for probably about 15 years. So it's kind of nice to be able to re-implement laddered bond portfolios into our picture. A second thing I want to look at is the stock market, or just in general the market. So this is it used to be called an Ibbotson chart, but it measures stocks, bonds, bills, and inflation going back to 1926. And so this was the date where we can get our most empirical information at that particular point that we know it's correct and valid information. And this is only going through 2020 through two, but the trend is still there. So what this is basically saying is historically small cap stocks have outperformed large cap, and that has not been the case for the last 15 years. And so up until maybe, like a few weeks ago. And then we can also see that government bonds have averaged about 5.2, treasury bills, which is kind of like money market funds, about 3.2, and inflation has averaged about 2.9. So all I'm trying to get at with showing this chart is that over the long run, stocks, equities do better over time than fixed income. However, we want to measure this with risk based upon the timing of when we need money, which we're going to look at here in just a second. But I just want you to recognize that even when we get into tough times, this is the area that kind of moves us forward and moves us up over time. The thing I think we have to talk a little bit about is technology, because it has massively outperformed the S&P 500. So if we take just the technology component stocks within the S&P 500, the blue line here is showing you what technology and communication services have been doing relative to the average of the full S&P 500, which technically is made up of, I think, about 503 stocks or 4 stocks, not 500, just so you know. But the technology and communication services this year is making up 42% of the S&P 500. It's never been that high as far as a percentage basis. And then if we pull out of that just those magnificent 7 that you keep hearing about that kind of became that were the FANG 5, and then they became the Fab 4. Now they're kind of back to 5 right now that are doing extremely well. That represents 33%. Just 7 companies are representing 33% of the S&P 500. So it's become very, very stretched. And all of this has been driven by the AI craze that actually started last year in April. And then kind of came out of it and then kind of came back into vogue. If we look at just the 3 powerhouse companies, NVIDIA, Apple, and Google, their capitalization today makes up more than every European stock market right now. I mean, that's just amazing. So this is what we're dealing with right now. This is where they're at now. And this is why maybe a little air is getting pulled out of the tire right now, because these guys have just kind of moved. Their earnings are there to support some of the price here, but yes, but maybe we've gotten a little bit too lofty, and we're kind of bringing things back a little bit to reality at this particular point. So this chart, and it's very busy, and I don't mean you to look at every little thing here. This is something that was called a Callan chart years ago. Callan created this, but everybody uses them now. It's looking year by year at the different asset classes and how well they have performed. And clearly there have been areas of the market that have outperformed and other areas that have underperformed. And the key to a diversified portfolio is that we want to ride through the middle here, so that we're capturing some of the up, but we're not needing to capture as much as the down too. And so that's where you see the white boxes and the lines kind of connecting the dots here to more or less say we're trying to ride through some of this as we move forward. And diversification is coming into play in a very positive way again, since about the mid-July that we're starting to see the broadening of the market coming into play. And that's a real positive at this point. So when the market is zigging and zagging and riding through the middle, it kind of helps us reduce that risk level that we could experience if we're just really heavily focused in one particular area of the market. And then the other thing I just want to bring to your attention is that fear sells. So we might start hearing a lot about bear markets, and goodness, we're just going to be entering into the third year of a bull market once we pass October 22nd in the second half of this year. But the thing about looking at this chart is to just recognize that the markets move in an escalator way. They kind of usually kind of move up and up and up, but they do come down in an elevator way, and it just kind of can be a little bit unnerving. The general feeling here, though, is that the bull markets last much longer than the bear markets. And as you can see by this chart, the bear markets are swift but short. Their bear markets are kind of methodical but longer. And if we can kind of keep that in mind, I think that might help people when they are experiencing this. And the media does do a really wonderful job at making people fearful of experiencing bear markets. But these pullbacks are normal. The pullbacks are also important to have because it's washing out the excesses and bringing things back in check to where they really need to be. So it's not necessarily a bad thing. We just kind of have to hold on. This chart is looking at, I think, time diversification and volatility. It's kind of giving us an understanding that stocks in 1 year, and if you look at the chart on the left, a 1-year holding, the green bar is the probability of what we can experience in the S&P 500. The best year return has been 52%. The worst year has been a negative 37%. And every year we're looking at this. That's the probability of a 1-year hold if we're 100% stocks. The second bar is looking at bonds. The best performance we've had is 33% positive, and the worst 13% down. So again, every year we can be maybe experiencing this. However, if we have a more diversified portfolio, 60% in bonds, 40% in 60% in equities, 40% in cash and bonds, then we are starting to see a compression of that bandwidth of what we can experience in a 1-year hold. As we shift ourselves out 5 years, 10 years, maybe 20 years, you can see that that bandwidth starts compressing. And so if we are dealing with investing, the key here is that when we're looking at our own time horizon, if our time horizon for needing money is less than 5 years, we do not want to have people invested in stocks, meaning that if you need some money out of your portfolio, you want to be able to pull it from money markets or short-term fixed income or the like. If your time horizon is greater than 5 years, the thing we also know is that the only asset class that gives you a protection or hedge against inflation is equities. It is not bonds or cash. That actually gives you stability in your portfolio, but it will not protect you from inflation. So we need some percent exposure in equities in our portfolios. So I think this chart does maybe a good job of giving that overview and understanding maybe that concept a little bit better. So some key takeaways for 2024, keep an eye on the big picture. Markets are projected to be more volatile. I just remember listening to an economist call at the beginning of July, and they said, well, usually about mid-July is when we start seeing in an election year volatility really picking up. And I think she was maybe off by a day or two, but boom, we started seeing that volatility coming into the picture. It's going to be there. Just recognize it. It's just going to be a part of what we're dealing with right now. We should be seeing a decline in interest rates. That is going to present some opportunities, and that's going to be a positive for the economy. And we do need to maintain a diversified portfolio within this. this confines. Our number one investment objective is our asset allocation. What is it? Is it on track? Are we where we should be? Do we need to do some rebalancing? I've been looking at this with our portfolios here the last few weeks, kind of running through everybody's, looking to see where we are here. So that's the number one important decision. And then the second is making sure that we're not adhering to a too narrow of an exposure in the markets right now, because some areas have really gotten overweighted here. And that broadening is coming into play. Security selection is a third thing we're looking at. Are we in active? Are we in passive? We don't want to pay too much for active. Most of the internal expense ratios that are higher are going to be in this area, but some active managers can provide benefit in a portfolio. So this is where we are not in the camp of all passive and all active. We look at where we're going to get the most appropriate move in these particular areas, given expenses and return. And then the last one is looking at security placement. If you have a taxable account versus tax deferred, sometimes it makes more sense to have some securities placed one place over the other for tax efficiency purposes. So that is another area that we're kind of looking at, making sure we've got things in check in that area too. So the key here is stay focused on your end game, not on the noise that is going on out there. We will ride through this and come out hopefully on the other end in a positive way. So this is our disclaimer, and I know we're probably going to be stopping the presentation recording.